technical glitches getting going. Just if someone can just send me a message quickly, just type a message. You can hear me loud and clear. I appreciate that. Okay, all working great. Thank you very much. Thanks for the feedback. Great, guys. Again, apologies for the late delay. We had some technical glitches. First webinar of the year, and this is what happens. Okay, welcome to our webinar today on some share market basics, basic share market concepts. The topic as such is called Introduction to the Share Market. Why shares? Here's my the agenda quickly. We've changed the format, by the way. We're going to have a shorter webinars, half an hour. I think it gives it's more impactful. But I can have it more often. So it'll be every Wednesday afternoon at 1 o'clock. So we can have more webinars more often. So here's the agenda. We're going to discuss traditional investments. And what are shares? Obviously, the whole focus today is on shares. What is a dividend? What is a share market? And ultimately, why the share market? Why invest in the share market? Okay. And then obviously, we discuss some of the webinars coming up in the next month or so, and obviously our traders forums around the country. Okay. So let's get into it. My objective today is to introduce basic share market concepts to you, also just to provide a better understanding of those concepts, but also mainly obviously to motivate investment in the JSE. And ultimately, obviously, to motivate trading and investing through PHG Online's platform. Okay, so that's my objectives today, and we'll see how it goes from there. Okay, now I brought in this topic of traditional investments just to give you a bit of insight or some background into it. So some of you I know are a bit more advanced investors and things like that, so just bear with me. There are many people on this call today that are still novices, are looking at the market, and looking at the options. And this is the idea, is to show you the different options. So let's talk about the normal traditional investments. We start off with savings in the bank. Obviously, this will allow you to earn interest on your money. This is for someone who's very conservative who wants that peace of mind. So obviously, you're getting a reasonable income yield, usually a few percentage points below the prime interest rate. Okay, obviously today with the Monetary Policy Committee meeting, we'll see what happens with interest rates. There's a possibility of interest rates going up. Okay, but interest is fairly assured if you invest in a major, one of the big top fives banks as such. But after tax, the yield is not much better than inflation. So this is just a place to park your money. But obviously, the advantage there, you have no risk of capital being eroded against with negative returns. So that's the advantage of putting your money in the bank. So there is a place for it within your whole investment asset allocation. I look at it just a place to park your money. Let's look at insurance products. Obviously, there are two major risks involved in life. You can either die too soon or you can live too long. So that's why you take out life insurance. You put money away for your old age. And obviously, the main thing is it's for retirement planning. So you get to some different kinds of products. We talk about term insurance. Obviously, this is the biggest cover with the least outlay. Obviously, you're not expecting, you're not going to get a lot of money if you survive the term. So it's usually a time period. It's taken out for fixed premium for fixed period of time. It's usually in the form of, like, for example, bond insurance and things like that. So it's just a way of providing certain life cover. That's what term insurance is all about. But obviously, the more popular investment products is endowment policies. This we have a bit of both worlds. You pay a premium for a certain number of years, and if you live until the end, obviously you receive the lump sum assured. Okay. Obviously, if you die when you're still making those contributions, it obviously goes to your state, to your heirs as such. So they're very popular in South Africa, but the disadvantage, historical returns have not been so good, and obviously of various different forms and obviously purposes. Most people use endowment policies mainly for the children's education. And obviously, that's a lot to do with the escalating cost of education here in South Africa. Okay. By the way, any questions you guys have, just type it up for me. And then sorry, I see a question coming, a statement coming here. He plays golf on Wednesdays. I'm sorry, I'm messing up your Wednesdays. Okay. These webinars are being recorded. So those of you that do attend the webinar, I'll be sending you the presentation. Okay. And we'll look, we will see if we might have some evening webinars going forward. If any questions, just send them through. If I don't answer the questions, I'll get back to you at the end of the presentation. Okay. Okay, great. There's no questions at this point in time. Great. Okay, so I'm sorry to spoil your Wednesdays with the golf. Okay, let's talk about the pension and provident funds. Obviously, this is obviously where a lot of people put their money. This is where you obviously with your employee, employer would be contributing to a pension fund. Defined contributions. This is what the basis they use at this point in time. But things are changing slowly, where the owners, the responsibility is shifting more and more to you as the individual. And obviously, with limited knowledge of the share market, it's important that you learn about the market. So that's where you can become vulnerable. But pension and provident funds have a place also within your investments as such. RAs, very, very popular. Obviously, this is more geared towards retirement. Obviously, it was originally designed for the self-employed person to provide for their retirement age, but now more and more individuals are using it now. So obviously, it provides a tax incentive. So you put money away, and obviously it reduces the government of possible liability in the future. So it mainly was originally designed for self-employed or professional people, but now obviously salaried people use that to supplement their retirement, the pension fund or the provident funds and things like that. So the main thing is tax relief, but you must not forget that the main thing is the main purpose of the retirement annuity is to provide for a retirement income. So what's nice about these things, if you look at some of the advantages, it's a disciplined way of saving. You can stop the contributions at any time. However, the money stays locked up until the age of 55 minimum. So that's one of the downfalls. On the other side of the coin is that contributions are tax deductible up to a certain limit as such. Obviously, the higher the marginal tax rate, the greater advantage. So they're also tax efficient at retirement. One of the big advantages of RAs, they're fully protected against creditors. In case you as a self-employed person goes insolvent, your creditors cannot get all of your RAs. Okay. What's also nice about these things, they are linked to various things like unit trust and things like that. So you can also go for higher returns. And what I like about it, I use it myself, you can switch it between the different funds and things like that. Okay. Let's talk about investing in property. In this point in time, in this situation, obviously we're referring to real estate, residential, commercial, industrial property. For most people, the home is the biggest investment. But the idea here is to build up a diversified portfolio, investment portfolio that includes exposure to the property market. We're talking about listed property. So you can look at your property unit trusts or what they call rates and things like that. There's various ways of getting involved in property. Here we're talking about commercial property. This is where we're talking specifically about shops and offices. And obviously the income yield from that on average historically has been between 8 and 14%. But it all depends always on location and quality. So you get this capital appreciation varies obviously from place to place, but also has between 9 and 11%. So your total return is around 18 to 24%. That's for good properties. And as I say, that is historical figures. Lower inflation will result in lower returns. So obviously it all implies a well-diversified property portfolio. But what's important, and this is what's nice about it, is that your income is fairly secure, provided you've got some good tenants. On the other side of the scale, you get high risk if you don't, if you no income coming in because the building is staying empty. So that's a disadvantage. So one way to get exposure to this is obviously through listed property shares. There's companies like Growthpoint and Redefine. Alternatively, we'll talk about it just now. We'll talk about the exchange traded funds. There's ways of means of getting involved in different funds there too. So let's talk about collective investment schemes. First of all, we'll talk about unit trusts. This is one of the most economical mediums for the average investor to have exposure to the market and to various asset classes. So you need a relatively small amount of money to invest, number one. And number two, this is for someone that wants to be a passive investor that hasn't got the time or expertise to play the share market. So unit trust provides access to professional advice. You're a professional fund manager that's managing your funds for you. Okay. One of the big advantages, obviously, you have diversification. So you're spreading your eggs in various baskets. Okay, so the idea is that we're putting our resources together into a fund, and then the fund manager would manage it from there. Okay, so you can either go a big lump sum or a regular monthly investments. So there's ways of means of doing it. Okay, but historically, there's about 1,000 funds available in the market, and roughly about 10% of them outperform the average of the market. So the challenge here is to choose the right funds and things like that. But what's nice about it, each fund has its own specific mandate or investment objectives, and obviously that's all described in the company's trust deed. There are various different types of unit trust. For example, general unit trust. This gives you access to a wide spectrum of sectors of the JSE. This ensures diversification, and obviously also offers this medium and long-term growth. You also get specialized unit trusts. There we more focus on more specific sectors, for example, the gold or industrial sectors. This all comes to the faith of the fund manager that has faith in certain sectors, be it IT or the financial services. Obviously, you'll have higher risk and obviously higher return compared to general unit trusts. You also got a group of unit trusts that are focused on income. So this is mainly focused on interest-bearing securities or instruments, mainly on bonds and debentures. So obviously the safety of the investment plus the interest is ensured. Okay. This is mainly for someone who's looking for high income as opposed to capital growth. So it's suitable for a retired person. Okay. Or someone that's got a short-term investment objective. So you can use it as a place to park your money. Okay. Advantages of unit trusts, they can be, as I mentioned just now, they can be linked to various things. You can link your unit trust, your RA to your unit trust, the other way around. They're very liquid. You can get your money back in a very short period of time. And also they're very visible. You can track your performance of your investment on a daily basis. The major disadvantage of unit trust is obviously when all the investors are involved in unit trusts or mutual funds or decide to sell at the same time. It will take the profits, or if, for example, a crash, they panic and everybody sells at the same time. Obviously, that can undermine the long-term investment objectives of your fund. So these things are designed as a long-term passive investment. One of the other disadvantages, costs can be higher than direct investment in the share market, but obviously you're paying the fund manager for his expertise. Okay. There could be a disadvantage in the sense that they are regulated there's a lot of regulations around it, so that could inhibit growth, but also the other side of the coin, that does give you that peace of mind. As I say, investment returns are not guaranteed, and roughly about 10% outperform the market. The trick is to find a fund that does consistently over a long period of time. So yeah, that's unit trust. Very similar to unit trusts, we talk about exchange traded products. It's a umbrella term for ETFs and exchange traded notes. Exchange traded funds have been around about 14 years now. Exchange traded notes have been around about 4 years. But the difference is that ETFs focus more on the equity side, and exchange traded notes are more a debt instrument and focus mainly on commodities and things like that. But similar to unit trust, they track listed investment products and check obviously a basket of shares or the underlying performance. So most of them are registered as unit trusts, with the notable exception of obviously New Gold, which holds a gold bullion. They are not registered as unit trusts. But they can be bought and sold intraday, whereas unit trusts are calculated at the closing price. Okay. So there's a lot of advantages of it. You can buy and sell quickly. They're low cost. It gives you that wide variety of securities or assets. They're regulated by the JSE as well as the Financial Services Board. Most ETFs pay out dividends or interest, whereas I mentioned just now, ETFs are more commodities or debt, and they obviously don't pay out any interest. Most of the ETFs are exempt from securities transfer tax, which is a levy levied on the purchaser side of the transaction, 0.25% of the value, but they're not applicable to all ETFs. Okay, so that can change. So ETPs are suitable for a range of investors, from the first-time investor to those that want to manage risks to pension funds. So very, very popular. I've added instruments here, derivative instruments. We talk about contracts for difference or CFDs and single stock futures. Obviously, it's a derivative on the underlying financial instrument or asset. I've added here, we're talking about traditional investments. A lot of people now perceive these things to be investments. They are trading tools. Remember, they were originally designed for people to hedge, protect the value of the share price, against, obviously against volatility or interest rate risk and things like that. But obviously, most people do use it for aggressive trading strategies. We talk about speculating or trading on the market. Obviously, it does offer higher returns, but does come with a higher risk. Okay, so these things are mainly for more advanced or a sophisticated investor that mainly wants to hedge existing share portfolio. So I've added in just to think of it as alternative, but as I say, it's more for. Remember, the major advantage here is capital efficiency. You can use less funds to have the same amount or big exposure to the market. This is what I want to focus on. Obviously, direct share investment. They've always been very good to the investors. Proven way to build wealth. Over the long term, obviously, they're tax effective. When I say long term, 3 years plus, obviously capital gains. That's what I mean by tax effective. And obviously, you can have a income stream and obviously beat inflation. Obviously, company share prices fluctuate. You need to be aware of various things. Incomes in the form of various dividends. Dividend yield roughly about 3% per annum, and that's not really assured. They introduced dividend withholding tax last year, which is roughly about 15% of whatever your dividends is. But just think about it, it's still 85% tax-free. So your capital growth is still very high, in the order of roughly, say, about 15%. Obviously, that's much better compared to cash, property, and bonds. So coming back to capital gains, your first 30,000 Rand of profit is tax-free, it's exempt from tax. So that's what I say they're very, very popular. So what are shares? Obviously, when a company wants to raise additional capital, finance expansion products, they'll sell the shares in the company to investors. So each share represents a portion of ownership in that company. Entitles you as a shareholder to a vote at important corporate matters, what they call the AGM. You can vote the directors out as such. Depends how much you got, how many shares you got. But it also entitles you to receive dividends if and when dividends are declared. So you as when you buy into those shares, you are termed now a shareholder. Another way of looking at shares, also known as equity, stocks, or securities. Okay, here in South Africa, we either call them shares or equities. The Americans love calling it stocks. Securities, to me, is more a generic term to cover all listed products. But there's a direct relationship between the number of shares you own and your portion of ownership. Okay, the more you own, obviously, the greater say you have at the AGM. I mentioned just now. Okay, so when the company makes a profit, you're entitled to that to a share of that profit. Obviously, it depends on how many shares you've got. So that slice of that company's profit is what we call a dividend. So here's a shareholder of various rights. We spoke about now you can receive the dividends, you get the right to vote. There's a lot of other things we can talk about. Okay, we just get into the more important stuff. The share price, obviously, that's the price at which a particular share can be bought or sold, and that's all determined by supply and demand. If there's more buyers than sellers, okay, the price will go up, and that's because of demand. The prices, if there's more sellers than buyers, the prices will fall because there's oversupply of shares. Pretty simple. That's what makes the market go up and down. That creates trends in the market. Your goal as an investor to try and find the shares that are undervalued. Okay, if the company is very profitable, obviously the company share price will become more valuable, and that's people's perception of the value. So there's a lot of other things that can affect it. It can be economic or the political climate. That can also influence the share price. Okay. There are various classes. I'm going to go through these very quickly. The most important one, and what I'm focused on, is obviously the ordinary shares. This is where you have ultimate control. These are the shares that have the voting power. You only have a right to the profits as and when they are declared, the dividends. If the company gets wound up, obviously you have a residual claim against the assets after the settlement of all debt. So whatever's left after all the creditors have been paid, you have that residual claim as a ordinary shareholder. They don't have a maturity date. They don't have a fixed income. Obviously, they are subject to price volatility. That's what you want as an investor or trader. So obviously, you assume a greater risk than compared to a preference or debenture shareholder. We'll talk about those now. However, most of the shares listed on the JSE are ordinary shares. So when the company does list in the market, they do commence the trading with issuing of ordinary shares. And later on, they might issue other classes of shares. Let's talk about other classes. We talk about preference shares. The main difference between here is that between an ordinary share and a preference share has a preference or a first option where dividends are declared and paid, number one. And secondly, obviously, they have a prior claim. If the company has to be wound up and assets sold off and creditors paid off, whatever's left, they'll get paid first before ordinary shareholders. So that's one of the big differences. The disadvantage is they do not have any voting rights. Obviously, there's various classes of dividend. I'm not going to go into too much detail now. All this information is available on Tutorial 1, which is available on the website. Okay. Debentures, this is or you can call it a loan contract between a company and an investor. So all it is, it represents a promise between the company to pay regular interest at regular intervals, and also to repay the capital amount at a specific future date or dates. So very similar to a bank deposit, a fixed bank deposit, in the sense that they pay interest and obviously not dividends. So this is again for an investor that's looking for income, not so worried about the capital growth, but obviously wants that income from interest. Okay. Again, there's various classes of debentures. So let's get into what is a dividend. Bank deposits attract interest, shares attract dividends. Okay. As I mentioned 4 or 5 times already, dividends are paid out of the company's profits only when it's declared by the company's directors. The two kinds of dividends there as such. You get a cash dividend or a scrip dividend. Cash dividend is usually paid into your trading account, or you might receive a check in the post. Excuse me. Scrip dividends, on the other hand, are in the form of additional or new shares. This is where a company decides rather to pay that, or you have the option to receive scrip dividends. This is where the company wants to conserve the cash, and obviously you as a shareholder will increase your shareholding in the company. So the dividend is not fixed. It's at the discretion of the directors, as and when profits are decided. Obviously, the directors of the company have to decide how much we're going to retain back in the business for future expansion and how much are we going to distribute to shareholders. Obviously, you want to keep shareholders happy. You want to see growth in dividends, and obviously, you'll see that being reflected in growth in the share price. There are two kinds of dividends that get paid out. Midway through the financial year, we talk about the interim dividend. The company anticipates the profits within that time period, and obviously we pay out the interim dividend. Then we have a final dividend. This is for the whole financial year, and that's based on the actual trading results of the whole full financial year. So every 6 months you should be getting dividends from a company that does pay dividends. Then there's some growth stock companies that are just starting out and want to grow. A lot of those companies don't pay out dividends, pay out any dividends. They reinvest all their dividends back to expand faster. Sometimes you also get what they call a special dividend. It's obviously this is made separate to a normal dividend. So obviously you'll see a separate issue date and things like that. But it's declared special in obviously compared to the share price. You usually find it's 20% or more bigger than the actual underlying share price. So that's what makes it a special dividend. The company sold off assets or sold off one of its divisions, but all this spare cash. Or probably retain some of the funds, but to pay out most of it to shareholders. Okay. There are 5 dividends to remember. Declaration date, obviously this is when the dividend is announced, also called an announcement date. Thereafter, obviously the company is eligible or it's got a legal liability to pay the dividend once it's declared. Got LDT, last day to trade. This is a very important date. It's usually a Friday. This is where the company goes ex-date. It's with the dividend. Okay, anybody that owns a share at that time, or anybody who buys the share on that particular day, will still be eligible for that dividend. But anybody who sells the shares will not be eligible for the dividend. Okay. After this date, usually the Monday, we're talking about ex-div. This would be the Monday. All shares bought and sold will not come with the right to receive the dividend. Okay, so it's a Friday, and the next Monday we have the ex-div date, and usually a week later from there we have the payment date. Okay, so the record date will be the next Friday, and then a week later will be the payment date. This is where your dividends will be actually paid into your account, into your brokerage account. So those are the 5 days to remember. Ex-div date, and then obviously payment dates are the 2 most important ones. What is the stock exchange? It's just a marketplace where shares are bought and sold in listed companies. Okay, we get 2 kinds of markets. We get what they call a primary market. This is where the company comes to the market to sell the shares to the public. Obviously, the main idea is to raise the funds. And then we also have what they call a secondary market. This is where you and I, as members of the public, will buy and sell those shares, between ourselves. Once the company lists those shares, they do not derive any further benefit from trading those shares. Obviously, they want a healthy market in the sense that the share price must be going up. So down the line, they can have a rights issue, raise more capital if needed. But also, it's important to have a good secondary market where we can buy and sell shares. Because if you know that you can't sell the shares, you won't be buying the shares in the first place. So that's quickly what we call a stock exchange. Obviously, the markets right around the world. Here in South Africa, it's called JSE. It's called the Johannesburg Securities Exchange. Okay. And obviously, the JSE has many roles. Main thing, it regulates a trading platform for buyers and sellers to trade. But also, their main objective is to protect investors by its rules and regulations, and obviously guarantees all trades transacted on this platform. It also offers a wide choice for companies and products. Here in South Africa, we've got around about 450 listed companies. There are a lot of different products or instruments to trade. Okay. And the objective is to provide an active and liquid market. So why shares? Bottom line, you do not need large sums of money to invest. People always think you need millions. You can start with lots of 1,000 rand. There's no minimums at PSG. Obviously, you take into consideration your costs. But you can start with a small amount of money and from there grow it. It's also very quick and simple to liquidate your funds. And obviously, shares entitle you to share in the profits of the company. Okay, without having to physically get involved in the business. A lot of people have this dream of having their own business one day. Imagine having a share portfolio of about 8 different companies. Directly own 8 different companies. You don't have to be involved in day running of those businesses. They're good quality stocks and they're profitable. The share prices will go up and you will be making money. Okay. So you only share in the profits of the company. If the company gets into problems and they start losing money, you're not going to lose any. They're not going to come take your house or your car away. Okay, so you're not responsible for the losses. And also, what's important is you can determine the value of your investment on a daily basis. You can go onto your website, you go to the newspaper, you can check the value of the portfolio. Then lastly, obviously, there is risk involved in investing in shares. However, you can limit that through educating yourself about the market and by also developing a sound investment approach, you're getting the odds in your favor. Secondly, by also selecting good quality stocks that are undervalued or that are profitable with manageable risks, again, you'll be outperforming most other forms of investment. Okay. So guys, I hope you've enjoyed it. I'll speak very quickly to try and catch up. But just in summary, obviously there's a range of traditional investments. History shows us that there's pressure on the market upward. Okay. So the trend of the market long term has always been up. So the reason why I'm punting on the share market is that you'll get the biggest bang for your buck from the shares. Okay. So it is a vehicle of choice for growth over the long term. Okay. So how do you know which shares to buy? Obviously, you need to increase your knowledge of the share market through research, and on the PSG Online platform, we have various research tools that help you make a more informed decision. But also through regular reading of financial literature, be it the Business Day or weekly magazines, financial magazines, as well as attending webinars like this, but also asking for advice from qualified people. You're going to start making better and better decisions. And that's how you're going to be successful in the market. Okay. So guys, just quickly, here's the webinars coming up. Next week, we're going to talk about the investment cycle. So this is one aspect that people they're always asking me about it. Where are we in the market right now? So this is just some pointers to look to that. And in the week after that, on the 12th of February, we're looking at technical analysis. This will be the basics. What is technical analysis? So we're going to talk about some of the basic assumptions of technical analysis. And obviously, going forward, there'll be a lot more involved. 3 weeks' time, we talk about inflation, interest rates, and the GDP. Because those are some of the most important macroeconomic concepts you can understand as an investor. Okay. And those of you that are interested in technical analysis, again, we're going to just focus on moving averages and Bollinger Bands. Okay. So with all these webinars, remember they are limited to the first 100 people. So first come, first serve. Please go onto the website and book like you did for this one. And then our upcoming traders forums, we've got one in 2 weeks' time here in Joburg on the 11th of February. We have it on a Tuesday night. The topic will be just a quick market overview of the market, discuss some investment and trading opportunities, and we're going to talk about trading equity derivatives. Just highlight that. And then those of you in Durban, I haven't confirmed it yet, but that should be going through no problem. At the Blue Waters Hotel on the 18th of February, I'll be coming down to Durban and showing you guys how to make money using equity derivatives. Okay, so quick conclusion. Just refer back to that tutorial 1 to go into a lot of this information. And the traditional investments, there's a tutorial called Smart Money Management. I took that from there. But I'll be sending you this PowerPoint presentation in the PDF format, as well as the webinar recording. Please go through it just to review it. Any questions you have, you're welcome to phone me and email me. Please support us of our webinars this year, as well as our Traders Forum. Remember, after each Traders Forum this year, we're going to have opportunity to have snacks and drinks, and that's where you can meet us. And I'd like to meet you and discuss the market and things like that, your trading strategies. So those of you that are thinking of opening up a trading account, think of opening an account with PSG today. And then from my side, lastly, good luck and happy trading. Let me see if there are any questions quickly. I know I've gone over time a bit, but just bear with me quickly. I can, yes I can, hear you. Those are some of the questions around the beginning. What makes a portfolio? Here's a question from Darren. What makes a question well diversified? Yeah, good question, Darren. Thank you. The idea that when I talk about a portfolio, I presume you're talking about an investment portfolio, a share portfolio. You want to have a spread of shares between 3 or 5 different sectors. I always say you want to have some financial shares, industrial shares, and some resources. You know, maybe have some IT stocks and some gold stocks and things like that. So if the rand gets stronger, like we saw today, you'll have some financial shares, and you'll see those shares will go up. If the rand gets weaker, you'll see your resource stocks or your rand hedge stocks go up. So the idea is to diversify between 8 and 12 different shares. And that's how you can spread your risk across a lot of different shares. I hope that answers your question, Darren. Okay, here's a question more about is this fixed property, about putting a property into a trust. Well, it's a bit of an advanced question. Obviously, I'm not a financial advisor, first of all. I personally do have properties in a trust. Remember, the main thing about a trust is asset protection. So it's also for my children one day to inherit. So, yeah. To answer your question, I don't have a problem with that. It is in a family trust. There's a question here also from, sorry guys, just want to bear with me, these questions are a bit very long questions. Placing life insurance as surety for buying new property, I don't know. I don't personally have life insurance, so I wouldn't know. Best thing to do is to speak to your financial advisor. Okay. Okay. Can the savings account, can the market the JC trustees, your money where you have your trading account, can that be influenced by the market? No, totally separate. Just the amount of money invested there. So, yeah, it's got nothing to do with what's happening with the performance of the market. So, yeah, it's relatively fixed. Okay, thanks, Lisa. Thanks, guys. Thanks. Okay, most guys have logged off already. So, guys, I hope you've enjoyed that. I hope you found it beneficial. As I said, I will be sending this presentation to you. Yeah, we'll talk again. Enjoy the rest of your day. Thank you. Bye-bye.